All right, guys, I'm going to try to explain this to you guys in a little bit of a layman's terms, and maybe you guys don't understand. Why the heck do you have any idea what you're doing in this stuff? And listen, when you're self-employed, you wear a lot of hats. Okay, I've worn so many hats over the last since 1991. I have not had a job, so I've even done real estate loans for a while. I did that for several years. I had a securities license. There's a whole bunch of other stuff you guys probably don't know about me, but anyway, let's get into the banking debacle and let me explain to you some of the reasons why this works. And this is the best of my understanding. I've never been a banker, but I have a little bit of knowledge about how that they work. Um, Typically, people think you go to the bank, you put your money in, they sell it as real estate loans or whatever, and then they make interest in that, and the money comes back. You know, they pay you a percentage of the interest rate or whatever. But that's not exactly how it all works. I mean, that's part of it. But they also have their cash reserves and things like T-bills. Okay, they have to be in some things that are considered 100% safe. T-bills, government bonds. They also do some real estate loans. They do some personal loans, some other types of loan situations, business loaning, and stuff. All that stuff is done. Different branches do different things, but a lot of their money ends up in government bonds or T-bills. And so when they have the kind of interest rate hikes that we have had over the last 6 months that quick, what happens is, let me explain to you how these government bonds work and T-bills. When the interest rate for the bond goes up, so when the rate goes up, the price goes down. So the net asset value of that, so let's say they've got $100,000 in bonds and they've been getting, 2% interest on them or whatever. And then all of a sudden, those bonds start paying 7% interest. I'm just giving you examples. The $100,000 asset becomes like $90,000 asset. It usually just offsets it exactly the amount by the return. Over time, what happens is that interest rate spread ends up paying back the bond amount. So when they have when the interest rate's higher, let's say they were only giving you 2% on your investment, on your bank account. They're not paying that, but let's say they give you 1% or a whole quarter percent or whatever, and that rate goes up. Okay, they start making that extra spread on the money, then they're able to cover the price difference. So even though the price of the bond goes down. Okay, so that 100,000 becomes 90. What happens is they're able to make that up over time. But when you have these rate increases immediate, like they've had really quick, and they're talking about even raising them higher, it puts a lot of uh, trouble in the bank, because what happens is they have to have a reserve requirement for them to be able to lend. And it doesn't mean that if they have $100,000 in the bank that they can lend out 100. That means they can, let's say they got $100,000 in deposits, they might be able to lend out like 10 million. So there's not really money to cover all that they have. So, that's a reserve requirement. So what happens is when they start having this spread happen, the T-bills go down in value. So now on top of that, then you've got, government bonds, and T-bills, and you've got there's, what are they called? Municipal bonds. They have those as well. Those are state programs like freeways and stuff like that. They might have bonds there, and the same thing happens on those. Um, and then they have real estate loans. So then what happens is, if we start having real estate values drop, okay, then what's going to happen is it's going to put more pressure on here. So what the Federal Reserve does is they do something called liquidity, and this is what you know, you guys may not understand, liquidity is just basically money. So the Federal Reserve goes and throws money back into the banks to have so that they can meet their reserve requirements so they can keep lending. But when the things keep going down like this, they have to tighten up. They can't keep doing that because their liquidity is barely covering their reserve requirements. So this is what's been happening in the banking world right now, and why banks could be in trouble. A lot of them aren't going to be, because the Fed's going to see it coming and they're going to throw some more money into it. But it really is almost like I don't know, the way I look at it, it's almost like a corrupt game, where these guys are entitled. You can have $100,000 in assets and lend out 10 million. I'm just giving you an example. It's the reserve requirements change all the time. So what might happen as well, so they throw liquidity into the banks, and then the money into the banks, liquidity, and then what they'll do is lower the reserve requirements. So now instead of having 100,000 to lend out 10 million, they'll have 10,000 to lend out 10 million. So that's kind of how it works. And then so what they normally do with real estate loans is they take those loans and then they sell them on the secondary market through to companies like, remember, Lehman Brothers and other secondary lenders out there. So these banks that you hear about are not FDIC insured. These are actually like large institution banks. I don't know exactly how they work, but they they buy the real estate loans, and what the bank does is they just make the servicing money on it. So for instance, a typical servicing amount might be 6% of the loan amount. So if they stop writing uh, real estate loans, then they don't get that servicing money, and that new servicing money. So that brings in less money. So when you start to see housing drop in price, as well as you see interest rates going up, it becomes a very difficult shell game for the uh, for the lenders to meet reserve requirements if they don't have a lot of liquidity. So this is kind of how this works, okay? And if you can kind of use that in your brain to kind of help you figure it out, that way you'll kind of understand what's happening out there in this market with this bank debacle. So anyway, I know a little bit about this stuff that doesn't make sense to you, and if it makes sense to you, I've kind of done my job on trying to take a complicated thing and make sense out of it. And it's really, they also do personal loans. They'll have their own portfolio of real estate loans, but most of that's sold on the secondary market to these other companies. These big investment companies like Lehman Brothers, Goldman Sachs. I'm trying to think of the other names of them. All the big, they used to have Bear Stearns was one of them. They used to, and and then those guys would sell them as investor packages, to like as bonds, I guess, how they did it. And then those things get sold to people as investments, and they're supposed to be safe. But when they did what they did last time in this whole thing was they had all these stated income loans that were stuck in the middle of this. And I'm going to go ahead and explain that to you because a lot of people don't understand. I got out of the real estate loan business because I was still doing it part time for a long time. When they came up with the Dodd-Frank rules, it was just stupid. It just didn't make sense for me to do it anymore. Profits all gone out of it. So this is why a lot of this stuff. That's why the housing market never truly recovered from the 2008 market crisis, because the Dodd-Frank was just terribly written. So what happened then is the secondary market, where they sell these loans, set parameters, okay? And they said, oh yeah, we will buy paper with 580 FICO score, 100%. We'll lend out 100%. Okay, they were, the secondary markets were creating loan programs that were horribly bad. Okay, so they were, taking a 580 credit score person and give them a 100% down, 100% lending power, or even 620. I remember some of the programs they had, and they were giving them a little higher rate or whatever, and giving them a loan when they probably shouldn't have lent to them anyway. And then they were saying, oh, by the way, you can do that with stated income. You don't even need to verify your income. We just whatever you tell us. You work at McDonald's and tell me you make 100,000 a year. We're just going to write it down. So the secondary market was the one that created this whole debacle last time. And what they did is they went after the loan officer. So let me give you an example. You can, if you understand, the secondary market is who buys the loans. The banks are just the people that go between. The secondary market is the one that buys the loans, like places like Goldman Sachs, Lehman Brothers. There's a ton of different ones, but Bear Stearns was one of them, obviously, that went under. And it was the people they actually package them and sell them. It's kind of a little more complicated than that, but this is what happens is they created the programs. They came up with these numbers and said to the salesman, who's called a loan officer, and a lot of them were done through loan brokers, right? So the salesman comes to them and says, hey, here's the programs, and you guys sell them, whatever. Well, what's going to happen? You're giving away, people, you're giving people an opportunity to get a loan, and the loan officer is just going to sign them up because basically he has no choice. Let me give you an example. Let's just turn this into cars for a second. Let's say a car manufacturer was making complete garbage cars, ones that fell apart and people died in, okay? And they said, okay, you, the car salesman, no, car salesman's the loan officer. So he's the car salesman, all right? And what's he going to do? He's got the only thing he has on his lot to sell are these garbage Hyundais. Let's say it's Hyundai. He's got garbage Hyundais and they fall apart and people die in them. And people come to him and they say, hey, I want one of those Hyundais. What's he going to do? He has no other choice. He's got to sell something because he's got to eat. And they go, what are you going to do? Oh, yeah, by the way, these are garbage cars. And, this is a terrible thing. You shouldn't buy it. Send all his customers away. No, he's going to just, okay, come on in, sit down, sign you up, give you the car, go on home, and, good luck with it. So what Dodd-Frank did is they went after the loan officers. Okay, does that make any sense? They went after and they changed all the parameters for loan officers and gave these guys a little slap on the hand and said, no problem. You just go ahead and, you're not going to jail. You don't get anything. You get no reprimand at all, nothing. And these guys who wrote these programs basically made junk cars that were just completely unsafe and, killing people. Basically that's what a real estate loan does when it collapses. It puts a family on the streets, okay? And they were selling these, and these guys had no choice but just to sell what's there, because let's say somebody came in and they go, okay, well, I don't want that kind of a loan. I don't want one of these bad loans. I want a good loan. And then you go, oh, well, okay, let me see if you can qualify. You do all these things. You don't qualify, sorry. What are they going to do? They're going to either walk away or you're going to sell them one of these. You're just going to give them one of these. You're going to go, oh, well, you can do this, okay? You can't qualify for this, but you can do this, okay? So what's going to happen is the loan officer is going to sell it. He just, you no choice. Either he eats or he doesn't eat. Now, the reason that I never got caught up in that is because I was part-time. So what I did in 2005, I saw the whole market collapsing in front of me. I knew it was going to happen. And people were coming up to me and going, hey, can you write me one of these? And I'm like, I have another business. I'm making money doing that. I'm like, nope. I go to him. Let me give you an example. Person comes to me, says they got a 5-year prepayment penalty. The payment's going to go up, $400, $600 a month, whatever. I go, in 5 years, what's going to change in your life? And I go, well, my wife's just having a baby right now, and in 5 years she can go back to work. Okay, we'll sign you up. That's great. I would take the loan. Another person goes, oh, no, I think this is all going to keep going up forever, and I'm going to invest and buy this home, and I'm figuring I'm going to sell it and make $100,000. I'd be like, nope, I'm not writing it. But look, the average guy who did this stuff full time, he could not do that. He could not make that decision. I could. And then guess what happened? They put up federal lending requirements. I was like told, you have to go get a federal license, and the profits all went to crap. I was like, I just don't want to do it anymore. I'm okay not doing it. So anyway, that's what happened to me in the whole business. And that's what happened in the last one. So people go, well, this is the same as what happened before. No, it's completely different. It's interest rate driven. Is it going to be solvable? Sure. They'll figure out a way to keep, lending liquidity. What's going to be the long-term outcome of it? Probably we're going to all end up paying for it, because all that Federal Reserve money isn't free. It's lent to us, and it all gets put into the banks to cover them. And it's almost like a bailout that happens. And sometimes, though, they have no interest on that money that goes into them. Sometimes it might have a due payment of in 5 years and not be renewable, so they have to pay it back. And if they expect interest rates to go back down, which I do not expect interest rates to go back down, I think we're going to be in for, I've been saying this for years, that we're going to have to go up. There's no way we can keep these, almost zero interest rates, because what happens if you have interest rates too low like that? Of course, you have inflation like we've got right now. And yes, it is inflation. It's not price gouging, you idiots. I can't believe people keep saying that. They just don't know anything about finance at all. So anyway, I'll talk to you guys in the next video. Hope to help you. Please like, share, and subscribe.